Credit scores stress most people out more than anything in the mortgage process. I want to talk about some of those myths and some of the realities. The biggest concern I have when clients approach me for a pre-approval is they think that that's going to take their FICO score down. It really doesn't. What happens with the FICO score is if I do an inquiry, it will drop your score anywhere from 3 to 10 basis points. But if the same type of lender does an inquiry after me and for the next 4 to 6 weeks, the algorithms know that you're rate shopping and they will only count the first hard hit. So people will be able to see that other mortgage brokers or other lenders have done inquiries. We would be able to visually see that you're shopping around. But the algorithms know that's normal human behavior and you don't get dinged every time. Now, if you are going around and seeking credit, you're going for a line of credit, your car lots are inquiring on you, you're trying to get credit cards. If you are doing odd credit seeking behavior, then that does drop your score every single time because it almost looks like you're running around to get a bunch of credit. But just having somebody inquire on your credit in order for you to get pre-approved for a mortgage or a loan is really not going to hurt you or affect your credit score. And it's the cost that you have to pay in order to get pre-approved. The other myth around credit is there's a lot of credit companies, Karma Credit, where you can look and see what your score is. But that score that you see is going to be a lot different than the score that I see. There's a company called FICO. And when we pull a score, we're paying a royalty to FICO for that score. So what you're seeing and what I see are going to be two different credit scores. Generally speaking, if you've got high credit, then you're going to have acceptable credit on the FICO score as well. What really affects your FICO score is a number of things. One of them is how thick is your credit file. The lenders like to see that you've had a credit history for at least 2 years or longer. If you've just established credit 3 months ago or 6 months ago, there's not a consistent repayment that they're able to measure or score you on. So a lot of times you'll actually have new credit, have a thin file, and have a really high credit score. But when the lender actually looks at it, there's not a lot of history. So there are times where a really high credit score really doesn't mean that much, and that's when your credit's thin. We also like to see at least 2 revolving type of credit facilities, whether that be a Visa or a line of credit with at least $5,000 limit. That really helps establish credit. There's a myth that term loans will help you establish credit. Those are like car loans where your monthly payment pays the balance down and then it's paid off and there's no revolving component. They don't help you build a credit score like a revolving line of credit does. If you don't pay that loan, it can affect your credit score in a derogatory manner, but they aren't that great at establishing credit because once it's paid off, it's no longer available to you. There's 2 other things we have to pay attention to. If you don't repay your credit as agreed, that will bring your credit score down. There are times where people might have moved and missed their TELUS bill payment. And when you look back at someone's credit history where that's happened, you can tell that it's a one-off and it's an anomaly. And those can usually be addressed to a lender in a note. This is what happened. It was a one-time thing. The lender will be able to eyeball your credit history and tell that's actually what happened, and you will be forgiven. But if you chronically are late on payments, they owed $200 to their Visa and they missed the payment last month because they know that they're going to pay it off in full next month. Don't skip a month. There is no mercy on your credit score fund. You always have to pay your minimum payment every single month. The other thing that's big is credit utilization. If you have 2 lines of credit, $5,000 and $5,000, and you are using one up to the limit of $5,000, you owe $5,000, you have $10,000 available to you, versus somebody that only has a $1,000 line of credit and they're using that full $1,000. So person A owes more, person B owes less. Person B's credit score is going to be a lot less than person A, and that's because of the utilization factor in your credit. Person A has used all of the credit that they have available to them, so it looks like they have no cash flow. Where person B, it doesn't really look at the amount that's owed. It looks like there's a lot more credit available. They're only using 50% of what's available to them, and the algorithms think that you have very good cash flow in that case. If you're thinking about closing a credit card, please don't. Some people like to just clean up their credit and only have a few. Keep them on hand because the longer they're reporting, the higher your FICO score is going to be. Credit scores of 680 and above, the probability of repayment is really high, and most of the lenders, that's their cutoff for best rates, best terms. Some of them have 720, but don't worry about that. 680 and above, probability of repayments high, that's an easy score for us to work with. The highest FICO score you can have is 900, and it's pretty exciting when we get somebody with a 900 because they're like a unicorn. Where we start to run into red flags is between 620 and 680. There's something going on there. It might be that you're getting higher credit utilization. You might have had one late payment that can be addressed. When your FICO score drops below 600, generally we would be looking for alternative lenders that are totally okay with bruised credit. Life is hard, life is expensive, things happen, and people have their credit score affected. There's lots of lenders that understand that life happens. As long as we've got the story and they understand the story, they'll be willing to lend to you. It just means the rate might be higher or there might be fees. Sometimes clients come to me and they're so worried about running a credit check on them. We need to run a credit check to pre-approve them. And what I find is that somebody else has put the fear in them that if they've had multiple inquiries, their score is going to drop to the point where they're not creditworthy. And that's not entirely true. And I really feel sometimes that lenders and other brokers say that to clients just to save the clients from shopping around. So I want to set the record straight on what my experience has been as a mortgage broker around credit scores.